Somewhere in a bond trading desk right now, someone is paying twice as much as they were paying 6 weeks ago to insure against Nvidia defaulting on its debt. Not because Nvidia is losing money, it isn't, not even close, but because of what's sitting underneath, the most exciting story in markets right now, and almost nobody is connecting it to the metal sitting quietly near record highs in the same portfolios. Here's the thing that should stop you cold. Gold closed yesterday at $4,424 an ounce, a 10-week high. Silver is above $67, its best level since June. Central banks bought roughly 289 tons of gold last quarter alone. And at the exact same time, the cost of insuring the debt of the company at the center of the AI boom just had its largest single-day spike since that insurance market started trading. Two completely different corners of finance moving at the same time, and I don't think that's a coincidence. I think one is starting to tell you something about the other. Stick with me, because by the end of this, I want you to understand a mechanism that most coverage of either gold or AI is treating as two separate stories when they're really one. Let me start with what's actually happening in AI financing, because you need this piece first for the rest to make sense. Nvidia doesn't just sell chips anymore. Over the past several months, it has signed or discussed a stack of financing arrangements that put together run past $750 billion. A partnership with South Korea's SK Group, valued at more than $500 billion, talks about guaranteeing as much as $250 billion so OpenAI can lease a massive data center campus in Ohio. A further discussion about financing $350 billion of OpenAI's chip purchases on top of that. And separately, Nvidia has signed agreements with 6 of the largest private capital firms in the world: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, to help mobilize more than $500 billion in outside financing for AI data centers. Here's why credit markets started to flinch. In a lot of these deals, Nvidia isn't just the seller. It's also, directly or indirectly, part of how the buyer affords to buy. Nvidia takes a stake in or backs the financing of a company. That company uses the money to buy Nvidia's chips, and the resulting revenue shows up as extraordinary growth on Nvidia's own books. Analysts call this circular financing. And both the IMF and the Bank for International Settlements have flagged it as a systemic risk worth watching. Jensen Huang has pushed back hard on that framing publicly, arguing the numbers are small relative to what these partners raise elsewhere on their own. That's a real counterargument, and I'm not going to pretend it away. Reasonable people disagree on how worried to be about this. But watch what the credit market did regardless. Nvidia's 5-year credit default swap. Essentially, the price of insurance against Nvidia defaulting sat around 42 basis points in late June. By mid-July, it was near 57. By late July, on the day the scale of these deals became clear, it spiked 14 basis points in a single session to a record 82 basis points. The sharpest one-day move since that insurance contract started trading in November of last year. Nvidia stock fell about 5% the same day. Now, 82 basis points is not a company on the verge of collapse. Traders generally start worrying about real distress well above 200. But the direction and the speed of the move matter more than the level. The stock market spent that week cheering the size of the deals. The credit market spent that week quietly repricing the risks sitting inside them. Those two markets don't usually disagree that sharply, that fast, over the same news. About 45 seconds in this is where you drop the subscribe ask. If this is the first time you've seen the AI financing story and the gold story sitting next to each other like this, that's exactly why I make these videos. To connect pieces that are sitting in plain sight in completely different news categories. Hit subscribe if you want more of this, and drop a comment telling me, are you more worried about an AI credit bubble or more worried about the bond market itself? I read every comment, and I want to know where this audience actually stands before we go further. Now, here's the second half of the mechanism, the part that actually explains why gold and silver are moving the way they are right now. This is happening while the Federal Reserve is stuck in a genuinely uncomfortable spot. Kevin Warsh took over as Fed Chair in May, replacing Jerome Powell on a mandate of tighter inflation discipline. In July, the Fed held its policy rate at 3.50 to 3.75%. But that vote wasn't clean. 3 officials dissented in favor of hiking immediately. Inflation is still running above the Fed's 2% target. Oil has been elevated for months on tension around the Strait of Hormuz. And right now, markets are pricing something like a coin flip probability, somewhere in the 50s, that the Fed actually raises rates again in September, not cuts them. That's an unusual position for a central bank to be in this deep into a cycle. An economy showing real cracks in places, but inflation still sticky enough that the Fed can't simply declare victory and ease. That tension is precisely the environment where gold tends to behave differently than the simple textbook rule suggests. The textbook rule says higher rates are bad for gold because gold pays you nothing and a treasury bond now pays you something real. That rule has held for stretches of this year. But gold just posted a 10-week high on a day when inflation data came in only modestly cooler than expected. Not because rates suddenly looked certain to fall, but because investors are increasingly treating gold as protection against something rate policy alone can't fix. China's central bank has now bought gold for 21 straight months. That's not a short-term trade. That's a multi-year institutional decision by people who manage sovereign reserves for a living. So, here's how I'd connect the two threads honestly, without pretending this is a sure thing, because it isn't. If the AI financing boom keeps expanding smoothly, if the revenue shows up, if the data centers get built, if the debt gets serviced, none of this needs to touch gold and silver in any dramatic way. Credit spreads settle back down, the Fed gets its data, and this becomes a footnote. But if any part of that circular financing chain runs into trouble, a hyperscaler pulls back capital expenditure, a financing partner gets nervous. A piece of that $750 billion in commitments has to be renegotiated. The shock doesn't stay contained in tech stocks. It runs straight into the same institutions that are also sitting on record government debt issuance. A Fed that's already divided about whether to hike or hold. And a bond market where Jamie Dimon, who has now repeated versions of this warning from a May 2025 speech through comments as recent as this April, has told regulators directly that a crack in the bond market is coming and that when it does, you're going to panic. Whether or not you think Dimon's timing is right, the mechanism, he's describing a market that has to absorb a rising supply of debt with a thinning pool of reliable buyers, is the same mechanism that would have to absorb any shock coming out of a stumble in AI-related financing. That's the actual trigger mechanism, not AI itself, not gold itself. It's what happens to confidence in credit markets broadly if the piece of the AI trade built on debt and interlocking guarantees turns out to be less solid than the stock price implies, landing on top of a Fed that already has less room to maneuver and a bond market that's already showing strain. Now, let me give you the honest other side, because I'd be doing you a disservice not to. Higher for longer rates are a real headwind for gold in the near term. A saver really can ask why hold a metal that pays nothing when short-term treasuries pay a solid yield. Nvidia's 82 basis point spread is nowhere near crisis territory. The company holds tens of billions in cash. Huang's argument that these financing numbers are small relative to what the AI ecosystem raises elsewhere isn't nothing. It's a genuinely contested read among serious analysts, not a fringe view. And warnings about debt spirals and bond market cracks have been issued for years without the predicted event arriving on schedule. It's entirely possible this AI financing wave gets absorbed the way previous scares have, the Fed finds room to ease later this year, and gold's current run cools off rather than accelerates. So here's what I'd actually watch if you want a way to track this yourself rather than take anyone's word for where it goes. First, Nvidia's credit default swap spread. If it keeps climbing past where it is now, rather than settling back down, that tells you credit markets still don't believe the "it's all fine" framing. Second, whether hyperscalers' actual capital spending keeps outrunning their free cash flow. Because that gap is what forces more of this onto debt in the first place. Third, the September Fed decision itself, and whether Warsh's language shifts toward acknowledging the credit stress showing up in these spreads. And fourth, and this is the one that actually matters most for gold and silver, specifically whether gold keeps rising even in weeks when Treasury yields also rise. Historically, when a safe haven asset climbs alongside higher yields, instead of falling because of them, that's the market quietly telling you it's pricing in something beyond the ordinary rate and inflation math. That divergence, if it keeps showing up, is the signal worth paying attention to more than any single headline. I'm not telling you what to do with that information. I'm not a financial advisor, and this isn't a recommendation to buy or sell anything. What I am telling you is that two stories that are usually covered by completely different reporters in completely different sections of the financial press are actually one story if you follow the money far enough. The AI boom is being built substantially on debt and interlocking guarantees. The bond market that has to absorb any stress from that is already thinner on reliable buyers than it used to be. And the asset that has historically been the pressure relief valve when confidence in that system gets tested is sitting at a 10-week high while central banks keep quietly adding to their reserves. Maybe this resolves itself calmly. It's happened before. But if you own any AI-adjacent stocks, any index fund with heavy tech weighting, or frankly, any exposure to the bond market at all through a pension or retirement account, you are already on one side of this, whether you've thought about it or not. Understanding the mechanism doesn't mean panicking about it. It means you'll actually understand the headlines when they come, instead of hearing about it after the fact like most people will. Tell me in the comments, which number are you going to be watching after this Nvidia's CDS spread, the September Fed decision, or the gold price itself? And if you've seen a credit market flash a warning like this before, in 2008 or any other cycle, I want to hear what it looked like from where you were standing. If this connected some dots for you, subscribe, because this mechanism is going to keep generating headlines through Jackson Hole and the September meeting, and I'll be tracking it in plain language as it develops.